Welcome to Looking at the Markets with David Modell. Today I'm honored to be speaking with a market and finance expert, and do not hesitate to call him an expert, Mr. Rob Kirby of KirbyAnalytics.com, and we will certainly be talking about that website and Mr. Kirby's services. But first we want to tap into his expertise today with the market at or near all-time highs. We're going to ask about silver and other commodities as a hedge or as an investment, and what the heck is just going on with this market. So first of all, Mr. Kirby, thank you so much for joining me today.
Pleasure to be with you, David.
Yeah, absolutely. I saw one of your interviews and I said, this guy is on point. I knew that already, but I said, wow, we got to get this guy, and I'm very fortunate to be speaking with you today. First of all, just real quick, if you'd like to tell anybody, in case they've been hiding under a rock, who is Rob Kirby, and what is your expertise and what is your financial background?
My financial background, after getting a degree in economics at York University in Canada, I went to work in the institutional interbroker capital markets, involved in institutional trading of foreign exchange and then money market instruments, both Canadian and then U.S., as in the Eurodollar deposit market. And then I moved on to be involved in when U.S. dollar interest rate derivatives were being conceptualized and incubated largely here in Toronto, Canada, by U.S. banking institutions. I had a good background in trading short-dated OTC interest rate swaps, and subsequent to that, I moved on into institutional bond brokerage, both Canadian and U.S. government bonds. So, bit of a spread of the institutional gamut from foreign exchange through to money market and debt instruments, and with a heavy emphasis on the derivatives markets. So that's sort of my background, and that stems from the early 1980s through to the late 1990s, my time in the institutional markets.
Absolutely. And are there any mentors that you'd like to give a shout out to?
Oh boy, you know what? I've learned from an awful lot of people who were very serious players at the time when interest rate derivatives were being created, and there's really just too many of them to list. So I've sort of been a bit of a sponge, gathering it up from a host of characters through the years.
Totally. I think we're all taking influence from so many people. It's hard to give credit to them all. Wanted to talk about KirbyAnalytics.com. What will people see when they visit that website, and what services are being offered at the moment?
Well, what I do is I write about the markets, and I've written an awful lot about the markets over the years, and I would say the emphasis of my writings have been on interest rates, precious metals, and probably with a pretty heavy overlay of energy, as in crude oil and natural gas markets. And there's a huge inventory of materials that I've written over the years. I probably have over the years written 800 or 900, maybe 1,000 commentaries that are in the public domain. But a lot of them are memory hold now. But they're all on the site in archival form for subscribers. And I write new pieces when I feel that I can make a contribution, these days. And I basically write for subscribers now, and I spend a lot of time conversing with my subscribers on issues that they have or questions they have regarding markets.
Absolutely. I'm looking at KirbyAnalytics.com right now. I see you've got Gold Fix, the real story on gold. And I'm assuming that's available now to anybody who wants to order that.
Yeah, well, that's what ended up happening. To be honest, David, with that book, when it was written, I produced 3 manuscripts. I had an agent who felt that he could get it placed with a publisher very very quickly, and much to his chagrin, after he took the manuscript and shopped it to a number of publishers. And understand the time frame when the book was written was 2004, and this was before any of the financial surprises we had stemming from the collapse of the subprime mortgage market and the financial crisis of the mid double O's. And he came back to me. He said, "This book will never be published anywhere," which I sort of laughed at because it was what I expected. So the book actually never went to print in hard copy. So what I do is I do distribute it to people free in electronic form if they request it. So that's sort of the history of the book.
Right. Right. Sounds great. And I'm looking at some of your articles. I mean, just the title: "Watching Fiat Fail While Central Bankers Crap Their Pants." Love
yes.
it.
Well, this is the ongoing train wreck of fiat money, which is very interesting. And just to make the point before we get going here on today's issues, fiat money by its very design, and its real creator in its current form can be attributed to John Maynard Keynes, who was a big promoter of this of this long hand of the government being involved in creating money out of thin air. Even John Maynard Keynes admitted, when questioned back at the time of the Bretton Woods Conference towards the end of the Second World War, because academics sort of cornered him and said, your scheme here of creating money out of thin air, by its very design, is guaranteed to fail. To which Maynard Keynes, and if I'm not quoting him word for word, the gist of what he said in response to these questioners was that, so what? In the long run, we're dead. We're all dead anyway.
Right.
Well, the problem with that is we're now living in the long run, and fiat money is failing, and it's failing in spades. And we have a media. Mainstream media that's vested its interests with the people in power, and the people in power are controlled by the people who control money, and the people who control money don't want to see this little act end where they get to be God and create money. And you see, this is the struggle that humanity has now found itself embroiled in. But rest assured, fiat money is failing, and every fiat currency, and there are literally hundreds of them that have been conceived, and they all end up failing. And the reason they end up failing is because, by their very design, they are constructed on a platform that guarantees their failure. And fiat money will fail just as sure as spring will follow winter, as summer will follow spring, and fall will follow summer, and winter follows fall, and so on. And because fiat money has a life cycle, it's born, it's birthed, it matures, and it dies. And we are now in the death throes of our current fiat monetary regime globally. And this is unavoidable. And frankly, how any academic worth their salt who has studied economics could make an argument counter to this is absolutely ridiculous.
Wow. Okay. I can see why you've been called the Johnny Rotten of economics.
Well, it's just a dose. It's, David, I'm sorry, it's a dose of reality.
Yeah. Yeah. And that's what we need. No, I like it. I like Johnny Rotten, and I like what you have to say. Absolutely. Speaking of a dose of reality, the market has been at or near all-time highs. since Brexit. We're talking about June, July of last year. We have not had any meaningful pullback since then, unless you want to count the 5% overnight futures dip on election night, which came right back up before the end of the trading day. So, with everything at all-time highs, should we be scared? Should we be worried? Should we be hedging? What should we be doing as retail investors and traders?
Well, I would have it that what we saw on election night, when markets were surprised with the announcement of a Trump win, the initial reaction in the marketplace with the surprise announcement of the Trump win was for equity markets, at least in the futures markets, was for equities to sewer, and they sewered very hard. The initial reaction was for precious metals to soar. Gold was up that evening close to $100. And you see, these outcomes or these results in our capital markets were not going to be tolerated by financial elites who have had an iron-clasp grip on our financial markets for a very long time. And they went to work about 11 o'clock at night on election night. I'm talking in like Eastern time zone reference.
Right.
They showed up for work, and they reversed this massive up, which was clearly going to become a manic explosion upwards in precious metals. And they slammed that into reverse, and by the next day, middle of the next day, gold was down. I don't know, it was down 40, 50, 60 bucks. It was so we saw a swing. We saw a swing probably of about $140 or $150 in the precious metals arena in gold, and in the equities we saw a horrendous sewering, reversed and turn into a very, very, very stiff up. And this has the earmarks of what some people would refer to as the plunge protection team.
Yeah.
I believe the handiwork is of what people refer to as the plunge protection team has an awful lot to do with a very secretive arm of the U.S. Treasury that exists. It's called the Exchange Stabilization Fund, or the ESF. And these are the entities that have the heft and the resources to make markets literally dance on the head of a pin if they so choose. And that night they really, really chose to do so, and they showed the power that they can exert on markets in a very short period of time. And it was literally, it was on display in its full glory. Just how much control central authorities have over markets on that night.
Yeah, manipulation at its finest. Wow, scary stuff. So, what do we do? I mean, for example, I'm looking at possibly some SLV, GLD. I like the ETFs because I do want to hedge. I do want to get out of get out of the market as much as possible. Am I safe in investing in commodities ETFs, or should I go with the physical stuff?
My personal view on the ETFs is that they're financial frauds. If you read the prospectuses on both GLD and SLV, you will find an awful lot of legalese and ambiguous language. There's no reason for there to be like such heavy applications of legalese and ambiguous language regarding custody of metal that is purported to be held by these entities. And when I see language like that, it makes me feel that something's being hidden, and I suspect financial scam. And the reason we know that such language is not required in a precious metals ETF, because there are examples of ETFs with very clean language that pre-existed the creation of GLD and SLV. And then I look at the people who act as the custodians and the managers of both GLD and SLV, And these are institutions that are known to be serial shorters, naked shorters in futures form of both silver and gold. And this to me, frankly, the creation of both GLD and SLV is when the regulators literally put the fox in the precious metals, both silver and gold hen houses, and told us all that, you know, all would be well, and told the investing public that you could invest safely in physical metal by buying GLD and SLV. And I believe that these entities were created to deflect institutional serious money away from buying real physical metal and into paper products that claim to but do not really stand for true physical precious metal. So that's my view of them. And I know there are people who would disagree with me, but the proof to me is in the pudding. The language is not consistent with something that's clean and decent and fair, and the players involved tell me that there's something very nefarious about both of those entities.
Gotcha. So, holding the physical silver, gold, what do you think? Is that the way to go?
I am a huge proponent of owning physical bars, coins in precious metal, and I'm also an advocate of people storing them or creating non-bank storage solutions for their physical holdings.
Gotcha. All right. Right now we've got gold hovering at around 1,200, silver at around 17. I've heard different predictions. What can we expect from gold and silver prices in the, let's say, the short to medium term, and as well as the long term?
Well, I would have it that gold and silver made nominal highs back in 1980 of $850 for gold, and roughly $50 US for an ounce of silver, and that was back in 1980. I would suggest that currency, as in the US dollar, has been seriously debased on a relative basis, where the dollar, in theory, should be much, much, much weaker relative to gold and silver today than it ever was back in 1980. And if we take 1980 prices or highs achieved in both metals and adjust for inflation using the government's bogus inflation statistics, which are dramatically understating the true level of inflation, you come up with a number something like $150 at least should be the price of silver right now in 1980 dollars, and a price of around, I think it's $2,400 US for gold, and that would just be in 1980 dollars constant to today. I mean, I live in Toronto, Canada, and I know what the price of a home was in 1980, and a price of a home that was $400,000 in 1980 today trades at around 1.2 million in nominal terms. So it doesn't really seem ridiculous to me at all to think that the price of silver per ounce could be 3 times what it was in 1980, and the price of gold could be 3 times, because to me they just naturally should be. And I would have it that the reason that they're not has been intervention by, I believe it's the U.S. Treasury that does the intervention. I believe the arm of the Treasury, the Exchange Stabilization Fund, is the tip of the spear in suppression of precious metals prices. And the reason the suppression is done, David, and to your listeners, the reason why banking authorities or financial elites want to suppress the price of precious metals is they serve as alternatives to their failing fiat currencies, and the failing fiat currencies are indeed failing, and they don't want us to recognize how badly they're failing, because if if we do realize, or if humanity collectively realizes all at once how badly they're failing, they will seek alternatives. So what the game is to make the natural alternatives and the historic alternatives look like they are not worthy. But the reality is the way they suppress the prices is through selling, let's just say, paper claims on the underlying thing, as in the case of gold. They sell COMEX gold futures to suppress the price of what we pay for a physical ounce of gold. And to put this into perspective, the amount of selling in gold in paper form from about 11 o'clock on election night through to Friday, which was 3 days forward, in paper form, there was 3 times global physical gold production sold in paper form to arrest and to keep the price of gold from going up. And you see, when you've got people being allowed to sell 3 times global physical production of gold for a year in three days or 2.5 days, this is not a sustainable course of action. You see, and in no other commodity in the world is this kind of behavior allowed. Like no entity would ever be allowed to sell wheat futures amounting to 3 times global production of wheat in 2 days or 3 days. It's not allowed. And you see, and the reality is there is commodities law in place that's supposed to prevent people from doing these things. And commodities law is supposed to be enforced by a group called the CFTC, which is the Commodity Futures Trading Corporation, which is the regulator over the futures markets in America. But because it's the government involved in suppressing the price of gold to protect the value of the dollar, it's viewed to be in the interests of national interest for the preservation of the dollar as a global trade settlement currency. They turn a blind eye and they don't enforce existing commodities law, and they effectively allow the government to commit crime. Well, that's all and well until the physical market decouples from the fraudulent paper trading entity, and this is coming because what we have seen over the last 15 years is a constant drain of physical gold away from the Western world and into the hands of the Chinese and the Russians and the Indians, because these people realize the fraud that's being committed by Western financial powers, and they don't want to buy or own the paper promises of precious metal. They want the real stuff.
Right.
And at some point we hit a wall. And the day we hit the wall, and the day the Chinese and the Russians stop getting their physical metal and are told that they're going to just get paper, that's when you're going to see these paper markets fail, and they will fail.
Yeah.
So that's what's in our future, and I can't tell you what day it's going to happen, but you know what? It's guaranteed to happen, because the amount of gold that comes out of the Earth's crust every year is finite, and the amount of gold that's in central bank vaults in the Western world is finite. And frankly, I think the number of ounces that central banks in the Western world, the number of ounces they claim to hold, I think is probably very fictitious at very best. And the true amount of gold that sovereign states in the Western world, the true amount that they hold is Chris Powell, the Secretary Treasurer of GATA, has said that this information is more closely guarded than nuclear secrets of countries. And the reason it is so closely guarded is as follows. If central banks don't have the amount of gold in their vaults that they claim to have, which we know that in large part they don't, the run on physical metal could intensify in a very, very short period of time, which could bring these exchanges like COMEX and LBMA into a default position. And the reason we know that they don't have the gold that they claim to have is because central banks are actively involved in leasing metal. And when they lease metal, the metal leaves the vault. It gets sold into the open market, and they replace the gold that left the vault with an IOU. But they count the gold that has left the vault in lease form as an IOU. They count it on the same line as gold that is present in the vault. So when central banks tell you they have X number of tons of gold in their vault, some percentage of that, or maybe the vast percentage of it, might be in an IOU form, which means it isn't really physically present in their vault. And this is called, if you and I were to conduct such accounting and try to pass it off as valid, we would be accused of fraud and we would be put in jail. Central banks do this as a matter of practice, and it's tolerated, and I would even hazard to say it's encouraged. So, central banks have different rules that apply to them with their accounting methods than what you and I or the corporate world would be subject to.
Right. Wow. You've given me more than I could ask for today. This is great. A little scary, but in a good way. This is what we need, is a dose of reality. One last question, if I may, because you've been so generous with your time today. I'm not going to ask you to be a top caller, but when is this dream or nightmare gonna end? I mean, are we nearing a swan song for the market here?
In my view, David, it could come any time, but I view what's occurred in a perverse way. It's given everybody an opportunity to do what precious metals aficionados refer to as stack. I believe that gold and silver maybe even more so than gold, are two of the most underappreciated assets on the planet. And when you have the ability to buy them at super depressed prices, it makes sense to buy a little bit, whenever you can. Yeah. So my view is there's never such thing as a bad day to buy physical precious metal. And the more that you own, the better off I believe you will find yourself long term. And I do believe that I'm going to live to see a day when wealth is measured not in dollars, but in ounces. So my question to you, if you want to feel wealthy or want to be wealthy in the future, you might want to start considering how many ounces you have in your possession.
Yeah, that's powerful words. Great advice. You heard it here. I've been speaking with Mr. Rob Kirby from Kirby Analytics, kirbyanalytics.com. If people want to tap into more of your knowledge and insight, how should they contact you through kirbyanalytics.com? Yep. Or what's the best way?
Best way is through my website, and I'm on the web at kirbyanalytics.com.
Gotcha. And of course I will throw that link up into the description of the video here on YouTube. And Mr. Rob Kirby, you've given me so much, and my audience, I'm sure, so much to think about, so much to digest, and that's what it's all about. This has been really informative, and I want to thank you so much for your generosity of your time and insight today, sir.
No problem at all, David. Pleasure meeting you.
Awesome. Okay, thank you.